Hey guys, welcome back to the Value Investor Show. Today, I want to talk about 3 undervalued stocks that I'm buying in November. Let's dive right into it. So for today's video, I'll cover the current market dynamics, the 3 stocks that I'm buying, a deep dive into each stock, their intrinsic values, and finally my closing thoughts. But in terms of market overview, the S&P 500 is currently flying. It's at an all-time high and many investors are celebrating, especially those who have invested in specific companies. Now, the next point is very important because it explains why the S&P 500 is at this highs. Just 15 companies make up 45% of the entire S&P 500. That means 15 companies represent nearly half the value of the 500 biggest companies in the world. Even more insane is the part that the top 3 companies alone make 21% of the index, and that's Nvidia, Apple, and Microsoft. So essentially, these 3 companies are driving the entire stock market. For some investors, that's great news. Most people are indirectly invested in these big names anyway, but it also means that there are many quality companies currently being ignored and undervalued, and those are exactly the ones that I'll talk about today. But more on a personal note, today I actually had one of the worst trading days in 6 years of investing because of one stock, Meta. Meta was down 12% at one point today after missing EPS expectations due to a heavy tax hit and large capex investments in AI. And here's the irony, companies like Nvidia are being praised for spending more on AI, while Meta gets punished for doing the exact same thing. It doesn't make sense, but that's the reality of the market right now. You have to deal with the dynamics that don't always add up. Still, Meta is one of the biggest multi-baggers that I have in my portfolio. I was up 4x just last week. Now, there are 3 companies that are massively undervalued and I'm buying more in November, and I'm throwing the Intelligent Investor book into the bin because it makes no sense that these companies are priced right now at the current prices. The first company that I'm buying more of this month is Deckers Corporation. Deckers is trading at extreme lows with a P/E ratio of 12. One of the cheapest valuations it had in decades. I have been talking about Deckers for a while. The stock hit $120 recently, but is now back to levels that we haven't seen in 3-4 years. The company reported earnings just a few days ago, and here's what the CEO said during the Q&A about guidance and growth expectations. An analyst asked about Q4 growth expectations for Hoka and UGG, both slightly lowered compared to prior estimates, and whether this was due to conservative assumptions. The CEO responded by saying that we have 2 of the healthiest brands in the global marketplace with a very strong and loyal consumer base and really a growing global demand. Our first half demonstrates the strength of these brands. For the back half, we are anticipating a more cautious consumer as the full impact of tariffs and price increases will be felt here in the US. Having said that, our brands are well positioned when the consumer shows up for the holidays. And as always said, we don't manage our business month to month and quarter to quarter. We build brands for the long-term profitable, sustainable growth. In other words, Deckers is playing the long game. They prefer to grow organically, stay conservative, and avoid over-expanding. Another analyst asked about Hoka specifically, about whether there are any product launches for 2026 and whether the brand could add billions in revenues in the coming years. The CEO said that their focus areas are performance, trail, hike, fitness, lifestyle, and over time they also see apparel. These 5 segments represent a 500 billion market. So there is massive upside. Hoka has only captured a tiny fraction so far. So in my opinion, the leadership remains overly cautious, which some investors dislike, but current trajectory suggests 5.6 billion in revenue ahead of the guidance, which was 5.3 billion. The company has been consistently growing for over a decade, beating estimates, growing both revenue and earnings, and there is no reason to believe that this will change. For me, the biggest risk for the business is firstly the lower disposable income and higher prices because of the pricing strategy of Hoka and UGG will hurt middle class spending. The second risk is that tariffs will continue to hit the bottom line. And the third one is, of course, rising competition. But there are also some very important opportunities and catalysts. The first one being the expansion into new global markets. Growth is already up 29% in Asia Pacific. And the second one is more of a stronger direct-to-consumer focus, which essentially means expanding margins through digital marketing and more focused targeted audiences. Now, in terms of valuation, there are three scenarios at play. The first one is the bear case scenario, which I assume is 6% revenue growth, 7% net income and free cash flow growth. The base case scenario, which is the one that I'm showcasing here, which we have 8% revenue growth and 11% net income and free cash flow growth, which is basically adjusted to accommodate what is being guided by management, and a bull case scenario, which is 10% revenue growth and 13% net income and free cash flow growth, which in my eyes, this could be very much a probable scenario. Under our base case here, I'm basically saying that the profit margins will increase slightly to 22% and revenue and the rest will continue to grow. So in my base case scenario with a P/E ratio of 19, which I think is fair given the growth rates, the intrinsic value with the DCF method is $184 and with the EPS method is $138. So it gives me a massive margin of safety to current prices. Now, if we look at the same with the bear case, and here I'm assuming a P/E ratio of 13, and with the growth rates that we've spoken about, the intrinsic value with the DCF method is $158, and with the EPS method is $78. So again, there is massive upside with the DCF method. With the EPS method, maybe not so much, but it's also because I'm using a P/E ratio of 13, which is very bearish. Now, for the bull case scenario, the DCF method gives me a $200 valuation, and with the EPS method a $151 valuation, again using a P/E ratio of 19, which gives me even higher margin of safety. So overall, this is a hugely undervalued company under all cases in my assumptions. Now, the second stock that I wanted to talk about is On Holding, another name that has been heavily beaten down recently. It was trading at $65 just 3 months ago and is now trading just under $40 for the first time this year since April. Analysts are expecting this company to be doing $1 billion in revenue by end of next year. This company has grown net income by 55% CAGR and revenues by 31% CAGR over the past 4 years. In terms of price targets, analysts see a $65 price target, implying more than 50% upside from current level. Even the most bearish forecasts in terms of price targets show upside from current levels. On Running reports Q3 earnings on the 11th of November, and I actually expect a double beat because estimates are rather quite conservative. Revenue is expected to be $762 million, which is up 19% year on year, which in my head is quite conservative, especially given the fact that the company has been growing 20% the last few quarters. And also EPS is expected to be 0.28, which again, in my head is quite conservative because it means a big dive from what has already been happening in the past. In terms of risks, there are three main risks. The first one is growth deceleration. If growth decelerates rapidly, we could see more downward pressure to the stock, just like what we've seen in Deckers. The second one is if FX headwinds persist, which this is the main reason why we have an inflated P/E ratio for On Running, because FX headwinds basically affected the net income of the company. And the third one is margin pressure from tariffs or expansion, which continues to create more pressure in the bottom line. While opportunities for the brands, the first one is new entry into new global markets, which accelerates growth, especially in Asia, as we have seen 100% growth the last quarter in Asia. And margins continue to expand as the brand gains more brand power and pricing power. Now, in terms of the valuation, in my valuation for the base case, the DCF intrinsic value with the 50% margin of safety is $34, and with the EPS and a 50% margin of safety is $37. So the current price is actually approaching my 50% margin of safety intrinsic value for the stock. On is growing across all key metrics: net income, EPS, sales, free cash flow, return of invested capital, and all the other ratios, as well as maintaining quite low debt, unlike peers like Nike, like Adidas. So overall, the company is very healthy and growing at extreme levels, double and triple the levels of the likes of tech, for example. Now, the third stock is Adobe, another stock that I have been heavily buying, that has been heavily beaten down 23% over the past year. There are two catalysts here for the stock. The first one is AI integration across its product suite. It's driving massive adoption as well as monetization. Tools like Creative Cloud Pro, Firefly are seeing strong uptake, with monthly active users up 25% year on year, and the AI assistant units up 40% quarter over quarter. AI was mentioned 110 times in the earnings call, yet despite that, Wall Street continues to ignore Adobe, focusing on only names like Nvidia, like Microsoft, like Palantir, and others. Adobe is actually one of the only companies that's actually showing monetization from its AI products. And also the company last quarter raised guidance for forward year 2025. The risks for the business are that firstly, in the long term, AI could replace the majority of Adobe applications. And the second one is that competitions like Canva, like Figma gain market share. Now, the opportunities for the company is that AI products become more integrated into workflows. And the second one is that Adobe expand its ecosystem, which already has extremely high switching costs that can make it extremely hard for enterprises and companies to leave Adobe's products. Now, most analysts are expecting Adobe to outperform in the next 12 months with the average price target of $480 versus the current $340. So overall, we are seeing a 40% upside in terms of what analysts expect in the next 12 months. In terms of my forecasted financials through to 2030, in my base case, I'm assuming 9% revenue growth, 12% EPS growth, and 12% free cash flow growth, and a P ratio of a 3-year average, which is 26. And under those assumptions, I'm basically saying that the profit margins will continue to expand from 29%, which is currently, to 33%, which I think is fair and is based on the current trajectory of how the company is performing, as well as some assumptions on the growth for the rest of the metrics here. And under those assumptions, my intrinsic value with the DCF method is $580, and with the EPS method is $510. So that gives me a margin of safety of 34 to 42%, which is very high and very close to my target margin of safety of 50%. So in terms of my final thoughts, year to date, I'm up 24% versus 14% for the S&P 500, but many of the stocks that I have recently invested are yet to fulfill their potential. For example, Decker. So if you're new here, please subscribe. I put so much time and effort putting these videos together. I will do a full portfolio reveal at 10,000 subscribers. And these three companies that I have spoken about today are the ones that I'm buying heavily this month. I will continue to cover them in the coming weeks. They're not broken businesses, just overlooked stocks in a market obsessed with a handful of companies. And that's not a bad thing, because it creates massive opportunities for patient long-term investors. Because at the end of the day, the real gains are made in the long term, not in the short term. Thank you guys so much for watching, and I'll see you guys in the next one.